Uh, Good afternoon, one and all. My name is Whit Ford. I'm a mentor with SCORE Maine, and welcome to Developing Your Cash Flow Projection. Today's workshop is sponsored by the Maine Technology Institute, who sponsors a number of our workshops, and we appreciate their support very much. That's what allows us to make these workshops available to you at no cost. I invite you to take a look at this income statement for a fictitious company and consider the question, do things look okay? Do things not look okay? Uh, what would lead you to feel one way or the other about this income statement? So looking at this, keep in the back of your mind whether you think all is going well or all is not going well, or what and why. And let's dive in a little bit of background. Now, you'll notice that there's 20,000 in revenue, expenses that are less than that, and then there's loan interest of $1,300, living and taxable income of $3,800 change. This is a typical income statement. And the challenge is that an income statement is not the same thing as a statement of cash flow. So the thing that is not showing on the income statement are any principal payments on debt. We saw the interest payment, but that was it. And as you may know, if you have a mortgage or any other form of debt, when you make a payment, that payment typically includes two components: the interest that is due on the loan, as well as repayment of principal to the lender. The interest is an expense on your income statement. The principal payment is not. So repaying a debt does not reduce your profitability. And therefore, looking at a profit and loss statement or an income statement or an earnings statement, whatever you like to call it, looking at that alone is not sufficient to help you figure out whether this company is consuming cash or generating cash. In this particular example, suppose their total indebtedness was about $25,000. If that was as part of a 10-year loan, then they'd only be paying $1,800 in principal every month, which would be fine because that's less than total profit. On the other hand, if there are only 5 years on the loan, then they'd be paying $4,420 a month in principal, which would have been more than their profits. So this original income statement that I showed you could be something that goes either way. All could be good with the company if the term of the loan was longer, but this company might be consuming its cash if the term of the loan was shorter. So the message here is that you cannot leap to conclusions about the amount of cash being generated by a company in looking at their income statement alone. You need to look at more than just the income statement. And that's what we'll talk about. So I invite you to ask questions as they arise. Just unmute yourself, or you can show your video if you wish, or put your question in the chat. I'd rather that you ask the question when it occurs to you rather than holding it, because it's often easier to answer then. And if you have the question, others probably are asking a similar one. So it helps to answer questions in the moment. Please do not hesitate to jump in. It doesn't bother me at all. My goal here is to answer your questions today. So what do I mean by cash flow? Cash flow means the amount of cash that a business generates or consumes over a period of time. We always have to be talking about a specific period of time. If I say my business had a positive cash flow last year, that implies that my bank balances grew. And if I said I have a negative cash flow last year, that would imply that my bank balances fell. So cash flow is largely about looking at what's happening to your bank account. And there are a number of things which influence any and every company's cash flow. The first, and the place every statement of cash flow starts, is the profits that the company reports. So starting with the income statement, as I did at the beginning here, makes perfect sense. It's just that profits alone are not enough to analyze a company's cash flow. There's usually one item that you will see on an income statement that is immediately undone in a statement of cash flows, and that is depreciation. If you are showing a depreciation charge on your income statement, a statement of cash flows starts by taking your income from your income statement and adding back depreciation, because depreciation is a non-cash expense. Depreciation is generally allowing you to gradually recover an expense that you made perhaps quite some time ago for an asset which has a long life, and therefore one which you are using up a little bit of every year that you're in business. And that depreciation charge is generally considered to be a way of recovering the cost of the assets that you use in your business. So when you capitalize that purchase of an asset that's long lived at the time that you purchase it, that means that the purchase cost is not fully expensed in that first year that you bought the asset. Instead, you divide the expected cost over its life by its lifetime, and that's your annual depreciation charge for that asset. And so you'll gradually recover that over time. So profits are usually the biggest source of cash flow for many companies, but they often slightly understate the effect on cash flow because they've been reduced by things like depreciation and other non-cash expenses, of which usually there aren't very many. But anyhow, depreciation is the big. The second big thing that has a significant impact on cash flow is any change in your inventory level. So I'm talking about the change in your inventory level here, not the level of inventory that you have. If you're looking at this year versus last year at the same time, then I'm looking at last year's inventory at this time versus this year's inventory at this time. And that is the difference that will affect my cash flow. If my inventory has grown, then I would expect that would have hurt my cash flow because I had to pay money in order to purchase that inventory. On the other hand, if my inventory has shrunk, then I would expect that my cash would have increased because I've been able to sell some inventory, and that generated cash that I did not have a year ago when it was all sitting in inventory. So look carefully at how your total inventory level, as reported on your balance sheet, has changed between the beginning of the period and the end of the period, and that is something that will have an impact on your cash flow. If inventory grows, then your cash will go down. Next up is changes in accounts receivable. In a similar sort of way, if your accounts receivable are fundamentally different at the end of this period than they were at the beginning of the period, then that will have affected your cash. For example, if your accounts receivable goes up, that means that more of your customers have not yet paid for products or services that they purchased. Well, if they've purchased it, then you've recognized that as revenue on your income statement. But if they have paid you yet, then the profits you're showing on your income statement haven't actually come in yet. Therefore, if accounts receivable goes up, that hurts your cash flow. If accounts receivable go down, that helps your cash flow. In the same vein, accounts payable are balances you owe to your vendors. And if your accounts payable have gone up, that means that you've purchased goods that you've not yet had to pay for, and therefore that helps your cash flow. If accounts payable go down, that hurts your cash flow. So these are three of the accounts that you'll see on your balance sheet that have a significant impact on your cash flow in the business over a period of time. Another one is your capital account. Any long-lived assets are generally listed under the bottom section of your asset sheet, asset side of your balance sheet. And most capital expenses for buildings or land or equipment or vehicles are shown there. Capital expenses are always shown at cost. They are not adjusted for the current market value of those items. However, that cost will then be reduced by accumulated depreciation to show a current estimated value of those expensive items on your balance sheet. If the total amount spent on purchasing long-lived assets has gone up from the beginning of the period to the end of the period, that implies that you have purchased new long-lived assets. In general, that will have reduced your cash, so that will affect your cash flow. Now, that could be mitigated in various ways. For example, you might have taken out a loan to help you make that purchase, in which case maybe they didn't hurt your cash flow, but in that case, the loan repayments probably will reduce your cash flow. That's okay. That's what happens, and you purchase them for a reason, so that's good. Anyhow, so that's something to keep in mind. And oops, I'm not seeing my screen anymore. There we go. So if your capital expenditures went up that year, then your cash flow will go down. If, on the other hand, you sold previously acquired goods, that will help your cash flow and your income. As in the example when I started out, if you are making debt payments and paying down principal on those payments, that will reduce or hurt your cash flow. And lastly, if you're a small company, as many of you probably are, owners of LLCs and things like that, if you take out owner's draws, which you might need to do to make estimated tax payments or things like that, or to just pay your living expenses, those owner's draws obviously take cash out of the company bank account and will hurt your cash flow. So these are the major things that most companies typically need to take into account when analyzing their cash flow. There is one of the three principal financial statements that your accounting software can generate called a statement of cash flows, and that analyzes your cash flow in minute detail. That gives you the most accurate answer to the question of how much did my cash change by over this period of time and why. However, I think you'll find that the things I've just discussed are often the largest sources of changes in your cash flow after profits. The statement of cash flows can be rather long and mind-numbing to consume. So in many cases, people are more comfortable forecasting cash flow by thinking about a series of smaller likely changes, such as these accounts, and allowing the rest of the stuff to just sort of hopefully come out in the wash. So why focus so much on cash flow? Because having a positive cash flow allows your business to survive, allows you to compensate yourself, allows your company to grow, allows you to obtain loans. Lenders aren't going to lend to you unless they see enough cash flow to make debt payments and then some. And cash flow allows you to make those payments after you have the loan. And then lastly, if you look ahead a bit and seek to forecast your cash flow, that allows you to note when your cash balance might start to get perilously low and apply for a loan to get you through that period well before you actually need it. If you plan ahead and apply for a loan because you know you'll need it, the lender is often going to give you credit for planning ahead. And if the need for a loan is temporary, a seasonal need, for example, they're often happy to lend you money. After all, they are in the business of lending money. So on the other hand, if you apply for a loan at the absolute last minute because you realized, oh my, I'm going to run out of money next month, they might be less confident in your management skills and might be less willing to make a loan to you. So it's well worth doing periodic cash flow forecasts in your business to look ahead and see if your bank balance is ever likely to fall below the level that lets you sleep well at night. That's the usual measure that I recommend to my clients here at SCORE. How much of a bank balance do you want to see in order for you to not worry about it and sleep well at night? The exact number will vary from one business to another. So let's turn to the process of forecasting your cash flow. I suggest that you forecast your revenues first, because if you forecast your expenses first, it's absolutely miraculous how often, once you know your total expenses, your revenue forecast ends up being slightly greater than your expense forecast. So instead, forecast your revenues first and then turn to your expenses. And that way, your revenue forecasts are likely to be more honest, if you will. We all like to deceive ourselves about the future. Now, I know that revenue forecasting is something that poses a challenge for a lot of people. First of all, the approach to forecasting your revenues would be very different from the way that I might forecast my revenues. Almost every business is probably going to have a slightly different way of forecasting the revenues. That's okay. It's going to be easier for some businesses to forecast revenues than others. That's also okay. It depends on the complexity of the business and the predictability of your markets. And then I often recommend that people forecast the revenues in a completely separate spreadsheet from the spreadsheet used to forecast your cash flow. And the reason for that is because you may find that you like having a relatively complex or sophisticated model for forecasting your revenues, but the person reading your cash flow forecast may not care about all that complexity in your revenue forecast. They care that you've thought about it. They care about the assumptions you made, but they don't necessarily need to see all the gory details. So I often suggest that people consider forecasting the revenues in their own little spreadsheet and then just taking the total revenue number and copying and pasting that into your cash flow forecast. So just to reiterate an earlier point, a forecast is just an informed guess. So nobody's expecting your forecast to be 100% correct. That said, do try to use third-party objective data when possible. Do try to use reasonable assumptions. Don't be incredibly optimistic or incredibly pessimistic everywhere in your forecast. And most importantly, document your assumptions. When you make the forecast, maybe off on the right somewhere, write down what assumption led to those numbers. Oh, I think my revenues next year are going to grow by 3% or 5% or whatever number. And then proceed to maybe cite whatever source you're using for that number based on an industry trade group white paper that was released last month, or based on the fact that my revenues have grown 5% a year for the past 3 years. So I'm predicting 5% again next year. Whatever your rationale was, document it so that somebody asks you, gee, where did that number come from? You can look right off to the side there and remind yourself of exactly where you found that number. 2 days after you do your forecast, you'll probably remember all that detail. But 2 months after you finish the forecast, you probably won't. So it's well worth documenting your assumptions as you make them as part of your cash flow forecast. So there are 2 approaches you can take to forecasting your revenues, top down and bottom up. Top down is one I'm not going to spend a lot of time talking about today, mainly because the way you would have to do this for your business might be completely different from the way I'm going to do it for my business. Namely, you start by researching your market size. Maybe that's nationally, maybe that's regionally, maybe it's in your city, depending on what data is available. Then you research your competition. How many competitors do I have? Are they bigger or smaller than I am? If you can get any competitive information on them, like what their total sales were last year, that's great. But if they're private companies, you probably can't get that data. You may have a sense of how much business you lose to them or win at their expense. And so you can probably come up with this estimate of your share of the market size that you just cited above. And if you take market size times your share, expressed as a percentage, that should equal your revenue. So that's one way to estimate your revenues. And if you think that next year you're going to grow your market share from 10% to 11%, okay, that could be a very reasonable basis for forecasting next year's revenues. I encourage you to try your hand at doing this later because you'll need to do some research on your market. If you want any assistance with this, you're welcome to sign up for a SCORE mentor. Our services are free. And we're happy to help you think through this process. An alternative approach that often is easier for many companies is to use a bottom-up approach. And to do this, you're going to start by analyzing your capacity. If you were operating at the highest level of capacity you can, how much revenue could you generate, say, every month? The reality is you're probably not operating at full capacity. So then take a step back and analyze what percentage of your capacity you think you're actually utilizing on average. Maybe it's per week or per month, your choice. And then estimate how much revenue you get from the average sale. Because this is something which, when multiplied by your capacity, if I can serve 20 customers a day and the average revenue is $50, well, then you're expecting to earn $1,000 a day. You can multiply that by the number of days of the month, and presto, you have a revenue estimate for the month. So this is a lot more doable for most companies, but it still may require you to go and collect some data about your operations, or if you're not yet in business, to make some guesses about what you think is actually going to happen. So first question is, what is your capacity? Think about if you were so busy that you had to decline business, you had to turn away business, what is it that would limit your revenues? What would cause you to turn away business? If you're a restaurant, it could be the number of tables or chairs that you have in the restaurant. If it's a yoga studio, it might be the number of clients you can fit according to the fire marshal, or just space constraints. It could be the number of staff you have and or their availability. It could be the equipment you have available. For example, if you only have 2 cash registers, it could be the number of cash registers that limit your maximum volume of sales in a day. So I encourage you to think about your business and keep some notes handy during this workshop and jot down items from your business that you feel might limit your capacity. The next big question is, what percentage of your capacity do you actually use? If your capacity is the maximum you can do, you're probably not operating at maximum all the time. Some companies do, but many don't. You might have seasonal variations. You might have variations by hour of the day. If you're a retail business, customers fill the shop at some times of day and not so much at others. That's pretty normal. So instead of thinking about only your capacity, think about, on average, what percentage of that capacity am I using? Just because I can cash out 30 customers an hour doesn't mean I actually do. If you look back at your history, you may find on average you cash out 10 customers an hour. Okay, that's your percentage of capacity utilization. And as you think about the percentage of capacity you're using, particularly if you are the sole owner of your company and you do everything for the company, don't forget to include the time that you have to spend on maintenance and administrative needs for your company. That potentially reduces your revenue generation capacity. So just as you noted your average capacity, also think about research and decide on what percentage of your capacity you think you're likely to use. And if you're in a seasonal business, do that by season. In your busy season, what percentage of capacity you're using, and that's probably a different number than in your slow season. Maybe you have more than 2 seasons. That's okay. Next up, think about what your average revenue is per unit of capacity. If you were a consultant, it might be per client. What's the average project worth to you? If you're a restaurant, it might be per table or maybe even per seat. Or if you are a retail establishment, maybe it's per staff hour. Or if you're a manufacturing company, maybe it's per machine hour. Anyhow, you might end up saying, well, I think that I tend to generate $5,000 of revenue per hour that my machine runs. Okay, if you're using the machine 80% of the time and the capacity is 40 hours a week, 40 times 0.8 times $5,000 gives you your expected revenue for the month. Let's take you through a couple examples of this. I used to do math tutoring on the side, and so this example is near and dear to my heart. During a school year, I had about 18 time slots available during the week. So that's my capacity. They were about 90% booked on average because I've been in tutor for years and years and years, and I got a lot of referrals. I charge $50 an hour. And so 18 hours, my capacity times 0.9, which is the percent of it that's used, times $50 an hour means I could expect to have revenues of about $810 per week, times an average of 4.35 weeks per month. So this would turn into $3,500 per month that I would expect to generate as a math tutor. But math tutoring is very different during the school year than it is during the summer. In the summer, I might only have 4 students a week, same calculation, that turns into $868 per month, quite a bit lower. So 2 seasons, one with higher revenues, one with lower revenues, and that might be one way of projecting revenues in a bottom-up fashion. Take a different type of business. Suppose I'm running an office cleaning business and I have 4 people cleaning offices on 2 crews. So I have 2 crews of 2 people each. If each crew works 40 hours a week, and if each crew can clean about 3,000 square feet of office space per hour, that's their capacity. But they may only spend 75% of their time cleaning. That's their capacity utilization. Why 75% of the time? Well, because I still have to pay them when they're driving to the job site. And once they get there, they got to get all their equipment out of the car and set it up. And when they're done cleaning, they got to put it back in the car and get to the next site. So it's fair to assume they are not going to be able to spend all of their time cleaning, but I still have to pay them for that time. I may be billing my clients at a rate of 15 cents per square foot cleaned. So 2 people times 40 hours, sorry, 2 crews times 40 hours per crew is the total number of hours they have at maximum capacity per week, times 75% utilization, times the 3,000 feet that they can clean, times 15 cents per square foot cleaned. Would come out to $27,000 per week that I might expect in revenues, times 4.35 weeks per month, gets me $117,000 a month. This sounds like a good business. On the other hand, sometimes it's very good to also have another scenario that you thought through. So what if my crew only works 30 hours a week, not 40 hours a week, because they have lives that prevent them from working 40 hours a week? Maybe they don't wish to work 40 hours a week. Maybe I don't have enough work for them to work 40 hours a week, whatever. And suppose they're not quite as efficient and they only clean 2,500 square feet per hour instead of 3,000. And suppose they only spend 70% of their time cleaning, not 75% of their time. Well, following the same calculation, this turns out to be only $68,000 a month instead of $117,000 a month. Whoa, big difference. Now, maybe I've been too pessimistic on some of the assumptions up here, but it's always useful to set up a little spreadsheet for yourself where you can play with some of these assumptions that went into your forecast and come up with an optimistic forecast and a pessimistic forecast. And maybe you pick something in between the two as your revenue forecast. It's just a guess. In general, it's probably better to be slightly conservative in your forecast, because if you exceed your revenue forecast, you're a hero. Whereas if you fail to meet your revenue forecast, you're a goat. So here's a template that I often use for cash flow forecasting. And I'm going to put a link to this in the chat here so that we can see things here. And let's see. My Zoom menus are in the way here. Okay, there we are. Screenshot, add a file. And the file I wish to add is this one. So this template that I just added to the chat is a monthly cash flow template. We have others on our website that are a quarterly cash flow template. And that is fine to use if you wish. It really depends on what you need for your business. If you're all seasonal, I would generally recommend a monthly cash flow template. Jen, I see you said you're not seeing a link in the chat. It may take a little while for it to propagate. I did send it to everyone, so you should see it. If not, I can dig up a web-based link for you, and I'll do that later. You'll definitely get a copy of this in an email along with the recording of this workshop. Did you receive it, Jen, or no, you just want me to send it later? No, okay, great, thanks. So I'll make sure, oh, thank you for saying thanks. But I'll make sure that it's sent out along with the recording and the slide deck for this workshop. So, so let's take you through a little guided tour of how you can fill things in here. At the top here, you have cash sale receipts. All cells in green are things that you're welcome to change. So you can change the titles applied to any of these here in column B. That's fine. These are just suggestions to prompt your thinking. They're not required elements of your forecast. You can also change the start date up, the start date up here, which says January 23. You can change that date and all the subsequent dates will change automatically. You can change the opening cash balance, and that will then flow through to the closing cash balances and all subsequent opening cash balances. For now, we've only talked about your revenue forecasts, and you would fill those in here on row 5. But it's also possible that in your business, you may sell some things on terms, meaning you let people pay in 2 weeks or 30 days, or you accept credit card payments and you don't get that cash for a while. So for those kinds of sales, you should put those receipts in the following month under accounts receivable paid. So you can put cash sales in the top line and then delayed receipts when you actually receive that cash in the second line. There's a third line there in case there's some other category you want to use. Other possible cash inflows include if you get a new loan, you might put the loan principal you just received here because that's a cash inflow to your business. And if you put more of your money into your business, you put that investment here under owner investments. Add up your cash receipts and you get total cash receipts. Add to that your opening bank balance and you get total cash available. And that's all we talked about so far. We'll come back to this in another minute. As I said, you're welcome to modify all the green cells. They are not locked. They are not locked. All the other cells are locked because you shouldn't need to change them if this spreadsheet will do. If you do wish to change them, you're welcome to. You can unprotect the sheet by going up to, I think it's revisions, and click on the unprotect sheet button. And there's no password, so you can unprotect it, and then you can step on the formulas if you wish to. So to get started with your cash flow forecast, estimate your bottom-up revenues in the manner that we just discussed. Second, think about, will they be steady state, or are they likely to grow, or are they likely to be seasonal? And then use that information to influence your numbers month to month in the worksheet. But before you settle on those numbers too much, go do your top-down research as well. Look at your competitors. How many of them do you have? How busy are they? What's your likely market share? How many customers are in the market that you serve? How often do they purchase? And then you can say that your revenue is going to be the market size times your percentage share times the average purchase size times the average purchase per month. And by the way, market size here is assumed to be in number of customers, not in dollars. If market size is in dollars, then market size times share should give you your dollars of revenue. Now, it's very useful once you've done both a bottom-up and a top-down revenue forecast to compare the two, because they're not going to result in the same number. Whichever is smaller is likely to be the number that is the more realistic forecast for your revenues. So the question is, are you limited by your capacity? If you could produce more, you could sell more. Or are you limited by the size of the market and or your competition? Meaning, even if you could produce more or sell more, maybe you couldn't sell them because your competitors are getting that business. So if it's the former, where if you could make it, they'd buy it, then it's worth investing in more capacity, perhaps. But if it's the latter, where no, you're constrained by your competition, then there might be no point in investing in greater capacity. Decide which of the two revenue projections is most defensible for you, which do you have the most confidence in, which do you feel your assumptions are most reasonable for. Think carefully about when you receive payment, as I mentioned, when you're looking at the worksheet, and make sure that your cash receipt estimates reflect when you actually receive payment, not when you made the sale. Then think about other potential sources of cash, as I outlined when you're looking at the worksheet, further investments that you may make or partner may make, loans you get, any grants that you win or competitions you win, crowdfunding. Those are all possible external sources of additional financing that would add to your cash balance. Enter any of these that apply onto the template, and ta-da, you have finished entering your sources of cash. So that gets us through the top two sections. Now we'll turn to the expenses. As I said before, the existing labels are there only as reminders. You're welcome to change them to whatever works best for your business. Note that if you are a startup business and you're forecasting the cash flow for the launch of your business, you will normally have quite a number of expenses that occur in the first month or two that do not occur again. So by all means, include your startup expenses in the first couple of months, but then get down to what you think your continuing operating expenses are going to be. Note that some of your expenses will vary with your revenues. These are typically called variable expenses. And the best example of this is your cost of goods sold. If you're a company that maintains inventory, when you sell something, you take it out of inventory and record it as a sale. And the cost of that sale is the cost of acquiring that product and keeping it in inventory. So you, on your income statement, might normally show revenues and then immediately subtract cost of goods sold to end up with a gross margin. Your cost of goods sold are variable expenses because if your sales go down, so will your cost of goods sold. If your sales go up, so will your cost of goods sold. So if you know that your revenues are rising or falling, it is perfectly reasonable to have all of your variable expenses rise or fall roughly in line with your revenues. There are other expenses, though, that vary, say, with temperature, such as your utility bills for gas for heating or electricity for heating, as well as just general electricity use. You only get plowing bills in the winter. So that's very seasonal. Then there are other things that'll be fixed, such as your rent or your insurance premium payments, or perhaps some of your payroll costs. If you pay some people on salary, those will be fixed expenses. Many of your hourly workers might be variable expenses, assuming that you allow your staffing to vary seasonally. So you need to think a bit about whether each expense that you're going to show varies with revenues or doesn't. And if you want to check your expenses, you may be able to find typical industry, average industry ratios for the industry that you're serving. If you can't find them on the internet, you may be able to find them either through a trade association or your bank may have access to various reports that they subscribe to for their underwriters who approve loans. And if they're willing to provide you with typical financial ratios for your industry, that can be very useful to you in coming up with your forecast for expenses. Note that you want to enter each expense when paid, because this is a cash flow forecast, not necessarily when incurred. In other words, if I order something from Amazon on my credit card, I'm not going to pay that expense until my credit card payment is due, which might be next month. That delay may be very important to your company's cash flow. So be careful to record expenses in the months that you expect the money to actually leave your checking account, not necessarily in the month where you place the order. Depends on the vendor you're buying it from. If you're already operating, hey, you've got some history. That makes your forecast a lot easier. Use your expense records to verify that your forecast numbers make sense in light of any growth or shrinkage that you're expecting in your business. If you're brand new to the business and just starting up, then all you can do is make your best estimate. You can base it on quotes received from suppliers or insurance agents, etc. Don't hesitate to ask for quotes and use those numbers as part of your cost estimates. You can base them on industry ratios, as I was just mentioning. You can get estimates for what your lease expenses might be from your anticipated landlord, even though you haven't signed the lease yet. They may be perfectly happy to tell you, if they know, what the previous tenant was paying in rent or utility bills. Well, they probably won't tell you what the previous tenant paying rent, but they'll tell you what they paid in utility bills, perhaps. Depends on the landlord, depends on the location. Anyhow, so don't be afraid to reach out to other people in the business to help get third-party opinions as to what your typical expenses might be, and also to get their feedback as to whether you truly have included all of the expense categories that you should. You don't want to miss anything if you can help it. Don't overlook your staff. If you have people that you're paying, don't neglect to include the payroll taxes you will owe on their compensation in your expenses. You will also probably have to make unemployment insurance payments and perhaps workers' compensation insurance premium payments. Don't overlook those. If your business was profitable last year, you may have to make quarterly estimated tax payments on the income being generated by your business. That's in April, June, September, and January. So that's something that you might have to withdraw cash from your business in order to make those payments. So if you're going to be taking money out of the business to make those payments, note them in your cash flow forecast. If you are a business based on keeping inventory, think about when you're going to need to purchase inventory. Do you have big seasonal inventory purchases in anticipation of the holidays, for example, or anticipation of your busy season, which could be summer or winter or spring or whatever? And if you have vendors that you make major purchases from, have you asked them for better terms lately? That might be a lower purchase price, or maybe you don't want to ask them for a lower purchase price. Maybe you just want to ask them if they're willing to accept payment 2 weeks or 4 weeks after they ship to you. Many large companies like Costco do not pay for the goods that they sell until after they've actually sold them. Their logistics network is so efficient that it's shipped, it gets on their sales floor, and it sells before they actually have to pay the bill from the vendor. How nice is that? You might not be able to do exactly that, but you might be able to take a step in that direction if some of your major vendors will let you pay on terms, pay a little bit after they ship it. Maybe even a week or two would help your cash flow. I don't know. That's why it's good to do a cash flow forecast. So as you look at your expenses, look at each expense line and ask yourself, should it be flat, meaning the same every month, or should it vary at various times of the year? Will it be something that grows before revenues actually grow, like your inventory expenses? Or will it grow at the same time revenues grow? Or will it grow after revenues grow? Things aren't always in lockstep. So think about the patterns in revenues versus expenses over time. Do expenses come before revenues, after revenues? What? As an example of that, you might have to buy inventory before you see the revenue from that inventory. But the payroll associated with selling that inventory might not be paid until 2 weeks after you generate the revenue. Think about which expense categories you're perfectly happy lumping together and just calling them, say, supplies or utilities, rather than listing them all individually. Sometimes it's a lot easier to forecast things as chunks than it is individually. Another reminder, you're welcome to change any labels that are in green to reflect the needs of your company. Don't hesitate to do a Google or an AI search for common expense areas in your industry, just to make sure you don't overlook any typical expense areas for your company. Did somebody have a question? I guess not. Okay. And then don't worry too much about your expense forecasts in total. Amazingly enough, errors in expense forecasts tend to approximately cancel one another out. So you'll probably find that your expense forecasts are within 10% of reality. That's not necessarily true of revenue forecasts, but it's often true for expense forecasts. So do the best you can, but don't obsess over things too much. So that takes us through this major body of expenses here. There'll be one thing below this sheet on the actual spreadsheet, when you see it, is a section for estimating loans. And those loan calculations will automatically be reflected in this loan interest line and loan principal line. So you can take advantage of the loan calculator that's just off the bottom of the spreadsheet to calculate the monthly payments for you based on the amount borrowed, the term of the loan, and the interest rate. Next up, we'll turn to this last section. Do you expect to have any capitalized expenses, say for renovations to your store or your office or your factory? Do you expect to buy any new equipment? All of those would be expenses which might typically be capitalized and depreciated over time, and therefore not hit your income statement. So if you are going to be paying for those out of your pocket, out of the company funds, that will have an impact on your future cash flow, and you want to make sure you include that in your forecast. Are you going to make any debt payments above and beyond the regularly scheduled payments. For instance, maybe you're planning to pay off a loan entirely early. Cool. If you want to do that, great. Just make sure you put that in your cash flow forecast as well. And any owner's draws, amounts that you as the owner take out of the business for personal expenses, to pay taxes, whatever, don't neglect to include those in the spreadsheet as well. Yes, Jen.
On the owner's draw, so you could pay yourself an amount on, say, a monthly basis, and that would be in your regular expenses, maybe, as opposed to an owner's draw. And I'm trying to compare and contrast those and how they're handled. So owner's draw, or paying the owner whatever, a payment. I mean, I don't want to call it a salary because it's not technically. And
Well,
as
you do
opposed
have the
to,
option. You do have
yeah.
the option of paying yourself as a W-2 employee if you wish,
Mm-hmm.
in which case you will need to be submitting payroll taxes every
Right.
pay period. On the other
So
hand, if you take the money out as an owner's draw, you don't necessarily have to make the payments quite so quickly. They typically would be included in your
yeah,
estimated tax payments
quarterly.
quarterly.
But right. And if you're an LLC, for example, you may not want to get into paying yourself as an employee, or you may, I don't know. Is there an
Yeah.
advantage one way or another?
Um, Most startups are not even thinking about owner's draws initially because they're not profitable yet.
Yep.
Um, at the point where they start to become profitable is when they can start to have an owner's draw. And at that point, they face a bit of a dilemma. Do I take the money out of the company because I need it,
Right.
or do I leave the money in the company because the company needs it?
So
Um,
there's another question then. Would it make sense to take an owner's draw, but then loan it back to the company as an investment?
no.
Okay.
And the reason for that is because an owner's draw is generally money on which taxes have not yet been paid. So it's pre-tax money. Um, it doesn't matter whether you take it out of the company or leave it in the company. What you're going to report in your tax return are the profits earned by the company.
Right.
And you're going to owe tax on all of those profits. And the owner's draw is not changing the profit of the company at all.
So that line item you have there for owner's investment, would that be simply money coming in from outside of the business?
It could be coming in from outside if it's up on the top, or if it's down on the bottom, it could be money the owner's taking out because, well, they need the money to pay their mortgage.
Yeah.
And so that doesn't change their taxes. And there's no reason to leave it in the company or take it out other than I need it or the company needs it.
Okay.
At some point, well, some point being the end of the year, at the end of the year, you file your tax return. And in the process of filing your tax return, you make a tax payment on the taxes owed, and that includes on income from your LLC. As soon as you've paid those taxes, any money that you put back into the company, you took it out, paid the taxes, had some left over, put it back in the company, would now become an after-tax owner's investment.
I see.
Whereas the pre-tax retained earnings number was still subject to taxes. And so you can't count on having all of that money available after taxes.
Right.
So there's really no difference between leaving the money in the company, paying the taxes on it, and then shifting it from retained earnings to owner's investment at the end of the year after taxes have been paid, or taking the money out, taking all the retained earnings out, paying the taxes on it, and then putting what's left back in the company as an additional owner's investment. Does that make sense?
Yeah, it's cleaner. I'm imagining it in my head. It looks cleaner.
Now, you can also sort of end up doing a combination of both of them if you want. But in general, um, the retained earnings number is money earned this year on which taxes have not yet been paid. And once taxes have been paid on that, um, if you took the taxes out of the company bank account, then retained earnings will have gone down. And what's left is all a reinvestment in the company. On the other hand, if you take it all out, pay the taxes and spend what's left on your mortgage, that's okay too.
Right, and then you lose the advantage for your company.
But there's no tax implication of putting the money back into the company after you
No,
pay taxes
no,
on it.
just strengthening it, I
Yeah,
guess.
it's just a question, does the company need the money to fund its growth or
Thank
operations?
you.
And that's the purpose of doing the cash flow forecast, to figure out whether your company does need the money to get through the months to come. So turning to the very bottom of the sheet, which I'll show you in a second, look at the line with the blue background. That is your ending cash balance. That is the whole purpose of doing this forecast, to look at your ending cash each month and make sure that it never gets too low so that you stop sleeping well at night. If you see a negative cash balance, that's a problem. That is potentially bankruptcy. Not necessarily, you might be able to finagle things for a month or two, but in general, if a month is getting close to zero, you should be concerned. And it's important to think about how low an ending bank balance you are going to be comfortable with while operating your business. So this blue line down here at the very bottom is your ending cash balance. And once you've forecast your revenues and your expenses and your cash inflows and your cash outflows, this is the number you want to look at, because you want to try to anticipate any months in which cash balances will be low. And when you identify them, you can then start strategizing. What could I do to improve the situation during those months? Maybe I'll postpone buying some inventory. Maybe I won't take a cash draw for myself out that month. I'll do it the following month. Um, there are lots of things that you might be able to do. We'll talk about some of them in a minute. Any other questions up until now? Okay. So some ways you can improve your cash balance in your business. Depending on the nature of your business, you may be able to ask your customers for a deposit. Obviously, if it's a retail business, that doesn't happen. But if they come and they place an order, which you'll deliver a month later after you've finished making it or developing it, you could probably ask them for a deposit. Some businesses might ask for a 10% deposit. Others might ask for a 50% deposit. Other might ask more. It all depends on the nature of the business. Many businesses will ask for a deposit that at least equals their anticipated expenses for that project. So I might ask for a deposit that will cover all the supplies I need to buy for this project. And maybe some of my labor, but maybe not my profit, kind of thing. That can do wonders for your cash flow if you're not asking for deposits and if you're in a business in which you can ask for a deposit. Secondly, you can control your expenses carefully, particularly your fixed expenses and inventory if you are in a business that relies on having a significant inventory. The timing of your inventory purchase can make a huge difference to your cash flow. So when you look at controlling your expenses, if you're a young business, you might wish to, say, sign a shorter term lease instead of a longer term one. Yes, it will cost you more, but it's not as much of a commitment. And you want to make sure that you start to get the revenues that you forecast before you commit to a longer term lease. Because if you go out of business and you still have 2 years left in the lease, you are legally obligated to pay that rent for the next 2 years. So it's not the monthly number that's important, it's the size of the total contract. So when you're new, be careful about longer term commitments. You can also, in the same vein, buy smaller quantities, perhaps at a higher cost per unit because you don't get the volume discount, but that's a smaller total financial commitment for you. Instead of buying 1,000 of the product that I think is going to sell well, maybe I'll only buy 200 and verify that they do sell quickly before I actually order 1,000. Yes, I might not get as good a price on the 200, and so my profits will be lower, but it's probably more important to verify that I really do understand my business well first before I make a financial commitment to maintaining a higher inventory until they sell, all in the interest of getting a lower cost per unit. The goal in either of these ideas is to reduce your total cash expenses in the earlier months until you've proven your business model to yourself, at which point you could pursue larger purchases at a lower cost per unit once you know that your cash flow will support them. And repeating something I said earlier, if you can, buy on terms so that you can pay after you receive the goods instead of when you order them. Your business cannot run out of cash. If you're a new business or a young business, you personally are probably the best source of cash for your business. So if you can, keep your day job because that's a guaranteed source of cash flow. If you're a business which has a seasonal need for cash, meaning things are fine except for 2 months leading up to the holidays or something when you're buying inventory, consider asking your bank for a line of credit. A line of credit is something that many people are not aware that exists. It's not a long-term loan. It's a loan that you can draw on and repay as you wish, just like your credit card in effect. Usually there's an annual fee. That fee depends on the maximum limit you're asking for on the line of credit. Sometimes there'll be a requirement that you pay it down to zero for 30 or 60 days a year consecutively. Sometimes they won't have such a requirement. But that is a brilliant way to have extra cash available for those couple of months that you tend to need it during the year. And you will only pay interest on the exact amount that you've borrowed for as long as you have borrowed it. The minute you pay it all back down, you don't owe any more interest. So it's a great way of getting extra cash for a short period of time when you need it at the expense of a little bit of interest. If your need is to fund growth, meaning your business needs working capital to fund hiring employees before you get the revenue from their work, or buying more inventory so that you have more product to sell, then you probably want to get a longer term loan from your bank. Typically, that will be repaid over a few years. I'm thinking 2, 3, 5 years. Banks are happy to consider such things if you can demonstrate that you have the cash flow in the business to service that loan every month. So they are going to ask you for a cash flow forecast. Gee, why have I been talking about all of this today? And a third need could be if your business is still relatively young, you may not have reached break even yet. And so your business is consuming cash every month, which is very normal. If you need more cash to get to the point where you start generating cash, break even, you could consider reaching out for a grant. There are relatively few grants out there. Your municipality may have some grants if you have employees. If you are in an innovation kind of business, the Maine Technology Institute might have some grants they could offer you to help you with aspects of our innovative economy. But in many cases, many founders end up going to a bank, and the bank will ask them to personally guarantee the loan to their business. In fact, for many young businesses, there's no way to get a loan from a bank without making a personal guarantee. That means that you personally promise to repay the loan if your business cannot do so. And you may need to pledge equity in your house or an investment account or something like that as collateral for the loan. So that covers everything I had to present to you. You'll be receiving a survey via email in a few days. So please do respond to the survey if you would. When you get the slide deck in the email again, this link here will take you to a list of all main workshops that are upcoming. I invite you to review them and attend some of our future workshops. In case you are curious about SCORE, we were founded in 1964. We offer free mentoring and main free workshops. We are a nonprofit organization, a partner of the Small Business Administration. We have over 300 offices throughout the United States, and I believe around 10,000 volunteers. So we have quite a network we can draw upon. If I'm your mentor and you stump me, I can call upon one of my colleagues to join us. And not only can they help you, but then I learn from them too. And it's a wonderful thing. If you'd like to sign up for a mentor, you're welcome to use this QR code to get exactly to the right spot on our website to sign up for a mentor. And with that, I will stop sharing and invite you to join the conversation if you have further questions. Yes, Jen.
Hi. Um, I've worked with a couple of clients who are real estate companies, and their cash flow is extremely challenging. Is there any strategic advice that you could point me to that I might be able to point them to?
Um, you said real estate management companies or real estate?
Real estate, I guess you'd call them agencies. Like they have like 4 to 5 realtors under
Okay.
the company. Yeah.
So they have a steady stream of expenses in the form of payroll and marketing expenses and
Yeah.
rent. And then they have periodic large infusions of cash
Yeah.
as properties sell and it's payday. But then a chunk of those cash infusions go right back out as commission payments. So the challenge there is, first of all, what is the contract they have with their brokers? Um,
Right.
you could say, no, we're not going to pay commissions the minute the deal closes. We are going to pay commissions 2 months later, 3 months later, over the next three
Oof.
months,
Yeah.
whatever. Um, just saying, hey, look, this is the way that we ensure we have enough money in company bank accounts to pay the rent next month. You
Yeah.
do want to keep the office next month, don't you? Um, we're also paying you some sort of salary, perhaps, and that's where that's coming out of. But in general, what I would say is if such a company is running into fairly frequent cash crunches, doesn't mean they run out of cash. It means it's just getting a little too low for comfort. Um, then they need to have a talk with their brokers, or they need more working capital.
Mm.
They,
Yeah,
they,
because it's human, when you think you're doing fine because there's money flowing, but when you get to the bottom of some of those big, tax time and other kinds of things, and you're like, oops,
yep.
it's really you've got to be so disciplined.
And that's where the cash flow forecast becomes really useful to
Right,
say, hey, if we hand out $10,000 in bonuses this month, we're $6,000 short come the next estimated tax payment.
right.
So we can't hand out the 10,000 right now if it's elective. We have to keep it in we have to keep at least 6,000 of it in the company. And so what that often means is that the owners of the company are going to hold off on taking their compensation
Right.
until the end of the year. And all the paid brokers who are under contract are probably going to get paid as per contract.
Hmm. I've got to find a way to get their accounting person, who, thank God, is a IRS certified accountant, to come up with a good working um, cash flow budget that they can keep going.
So I would start by asking for a monthly cash flow statement for last year
Okay.
and look at the details of where the cash came and went in each month. It's not that you're going to repeat exactly the same pattern, but they probably are seasonal patterns because real estate is somewhat of a seasonal
Yeah.
business.
Yeah.
And so in those seasons of heavy transactions volumes, um, you may find that the owners need to just pay their brokers, but not do any draws themselves.
Yeah.
And then once everything's settled down and estimated tax has been paid, that's when the owners could think about taking their draws.
Okay. And that's okay to ask the accountant. She can pull that up for me.
Yeah,
Okay.
most accounting software should be able to produce a
Yeah,
statement
she
of cash
seems pretty
flows.
good. I just, people don't always have the right team around them either. So you have to really know what you need for your situation. So I think I'll do that. I thank you, Whit, for that suggestion. That'll help me a lot to help the owner see her situation clearly.
Yeah, and if you can just show the owners, they don't need to see all the green cells. You could just sort of say, here's the blue line.
Yeah,
Here's the projected cash balance every month for the next 12 months. As you can see, we go negative in these months. And then you can just state the reason we go negative in those months is payment of estimated taxes, or
right.
that's a big month for brokerage commissions or whatever. And if you know the primary big reason why that month behaves that way, you can just cite it and say, we need to keep at least this much money, this much being the most negative balance you see,
Mhm.
plus a bit. Um,
Yeah.
yeah,
I
we
was
need to
trying
keep
to
at
get her
least
to
that
keep,
much.
yeah, I was trying to get her to keep a percent of every what the agency received for every closing, aside for those estimated taxes and anything that might come up, um, because you never know.
Yeah.
And so she tried it anyway. We'll see.
Yeah, and if the owners don't like it, well, then you're stuck.
Oh yeah,
If the owners uh, may say, well, what else can we do? You could say, well, this ain't going to work, because we run out of cash 6 months from now.
I know.
So then we need to get a line of credit to get
Right,
us through that 2 month period or 3 month period when cash isn't working.
right. And it is really a challenge when you have a company that flows so much cash through it, but in such a very strange manner,
Yeah.
you know.
And so, I would, well, it's
Yeah,
easy
I
for me
get
to say, tell the owners they need to go on a diet until the year is over, and then they can take the cash out
you. Thank you, Whit.
any day. Other questions? I'm happy to address the specifics of your business if you have questions, but
I just have one other question, Jen again.
yeah.
So what would also be in the future maybe helpful for a course or something is to talk a little bit about strategy. And I mean, you touched on some of those, but like maybe do a case study or something of a service and a product based business, and speak a little bit so that it gets people's brains thinking about, you know, I mean, it is emotional, it is overwhelming, it is a lot to take in, but if you start to interact with it, it somehow sits inside a little bit better.
I did have the cleaning business and the tutoring business as two sort of mini case studies
Yeah,
for parts of it.
we just need more
Um,
time, I think, to
yeah, the
engage. Maybe,
challenge is
yeah, yeah,
we have to fit it all into an hour
I
ish.
know.
I know this goes an hour and a half. And we used to do things like this in person, and it used to be a 3-hour workshop. So we had lots of time to go into case studies and answer all sorts of questions, and that's harder to come by these days. So anyhow, I appreciate your questions, and that's a brilliant suggestion. And if I have time, I'm happy to do that.
Thanks.
Not seeing any other questions, and coming up on an hour and a half, which was the advertised duration. I'll conclude by thanking you for joining us today, inviting you to come to
Hi, I'm
future
sorry.
workshops. Oh, yeah,
You
yes,
know,
Lisa.
oh, so sorry about that. I have a question, which I don't know if it relates to this class or not, but I really love the flow of this and just thinking through strategically and proactively about cash flow. My question was, when it now comes to the different functional units of the business, so specifically marketing, can this be applied to particular departments, or is marketing budget a whole different process of its own? So, yeah.
I would give you a painful non-answer. Yes and no. Yes, in the sense that every department is probably already used to coming up with a budget, and that budget ideally would be a monthly budget if their expenses are not spread necessarily evenly throughout the year. And so if you enter that budget on a monthly basis into your accounting software, you can look at actual versus budget and have that be a fair measure of management success, if you will. However, in the case of marketing, marketing doesn't really generate revenue directly. That comes from sales, depending on how you define marketing, of course. But so all of marketing's cash flow would be negative. It's just some months are more negative than others because the marketing cycle, well, exists and varies during very different parts of the year for your industry. So that's totally normal. And what's really most important is that the company's chief financial officer be aware of what that typical cash flow cycle is going to be so that their analysis of what the financial needs of the company are is accurate. And so they depend on that budget as a cash flow budget, more so than as an income statement budget. And I would argue that your budgeting process is largely a cash flow forecast for the marketing department. Does that hold
Yes,
true in
no,
your
that's thank
experience?
you. No, very helpful. No, thank you for that clarification. Thanks a lot. And a side note for Jen, if she's listening, I'm also a real estate broker, so I completely understood what she was, asking and all of that stuff. So, I mean, for her friend, if she's in a state where a virtual brokerage is allowed, she can look into that as well as a managing broker. That's what we did when COVID hit. We closed all the offices, and yeah, everything is virtual. So it really took down a lot of the burden of trying to get transactions, things like that, because everybody knows the market is not what it used to be. So yeah, that was just a tip there, just to help with the cash flow, because I know it could be a lot in
That,
these times. Yeah.
that would greatly reduce your fixed costs if you don't have a lease payment to make every month.
Thank you, Lisa.
Other questions? Well, it's a beautiful sunny afternoon, so get out there and enjoy it, hopefully at some point. Thank you for joining us, and I look forward to seeing you in a future workshop. Have a good afternoon.